The recorder's going, okay.
Issue the
We are at 11:59, but by my watch, it's, or 10:59, but by my watch, it's 11 o'clock and 20 seconds, so that means it's time for us to start. So thank you, everyone, for joining us for the December Director's Cut, putting out that October data, so we welcome you all. Remember the rules of the road. Try to stick to the topic of the Director's Cut, and you'll keep me one happy PIO. And with that, I don't have anything else. So, Mr. Helms, go ahead.
All right, thanks, Allison, and thanks everyone for attending or tuning in to the webinar. We're looking at October production, and there are probably more variables at play now than we've ever seen in the past. So I'm going to give a quick run through and then talk about the label that I've attached to our December webinar Director's Cut. So production up almost 7,000 barrels a day, 6,800 barrels a day. Gas production up almost 47 million cubic feet a day. At the same time, oil price fell $5 as a result of OPEC's indecision or decision not to decide, with crude oil price at $27 for North Dakota Sweet. Operators are indicating with 65 rigs running that unless prices improve, there could be another reduction of an additional 10 rigs out of that rig count. The number of well completions is down substantially from 123 to 43, yet production is up. The number of wells in the non-completed category is down 105, and yet well completions is down. And so there are a lot of moving parts here. What we think happened is a significant number of operators in response to the extension of or the moving of the flaring goals, opened some wells up, put some wells back on production that were restricted or shut in the September time frame. Probably the biggest thing that we see happening right now at Oil and Gas Division is mergers and acquisitions. I stepped in the bonding secretary's room this morning and took a look at the whiteboard that keeps track of those. 710 wells currently in the merger and acquisition mode. 9 new operators planning to acquire North Dakota properties and become operators in North Dakota. So we're seeing another new tool being used by the Bakken operators to improve cash flow and improve the bottom line in terms of maintaining their rig count, maintaining their well completions. So production's up, but completions are down. Rig count is up 1, but looks like it's going to go down. Oil price is down. Gas production is up, but capture percentage is up. So I'm calling this month, Where's Waldo? Quite honestly, there are so many things at play that to try to make predictions about what's going to happen over the next few months is virtually impossible. What we do know is OPEC is indicating that they don't think that reductions in production would improve the price scenario until the second half of next year. So we're looking at a lot of belt tightening, and we're looking at it continuing through in the entire first half of 2016. And a huge amount of merger and acquisition activity. Production is running for the biennium 6% above revenue forecast projection, but price is 23% below revenue forecast projections. So overall, revenues are going to be significantly lower. And so there's going to be some talk of a new revenue forecast and what that might mean for state government. That's all the information I had planned to put out there. Take questions.
Well, nobody's got any questions.
When you said, I guess, you expected the rig count maybe to drop another 10, do you know kind of like what the time frame for that?
operators have talked about the fact that it's their contracts, they've positioned their contracts to make that reduction over the first 6 months of next year. So it probably won't be a sudden drop. It'll probably be a phased-in drop over the first half of next year.
To follow up on that, I'm still assuming that they're in the sweet spot, basically, still drilling there mostly.
Yeah, the question was, are they still drilling in the sweet spot? And at what we estimate the current North Dakota realized price to be, which is in the $32 to $33 range, only the southern half of Mountain Trail, the eastern half of Williams and McKenzie, and the northern half of Dunn makes sense. And so virtually all of the rigs are focused in that small area. And I think that's why we're seeing gas production increase so much more rapidly than oil production. Though that's a high gas oil ratio area, and so it's putting a lot of pressure on the gathering system. Fantastic to see gas capture go up so much. So we did a little checking to see how that could possibly happen. One Oak is running 100 million cubic feet a day above nameplate capacity at their existing plants. And so because of the great weather and because they did so many compression enhancements over the summer, they've actually been able to push their existing natural gas plants to 10% above their listed capacity. That's not going to stay that way because Lonesome Creek is on schedule and should be on fully operational sometime in January. And that's a 200 million a day plant. So that'll relieve that pressure. But they've actually been able to operate their existing plants at well above nameplate capacity.
So just to follow up with that, is that probably the reason why companies were able to increase gas capture in October?
Yes, that would be accurate. The reason companies were able to increase gas capture and take some wells off the shut-in list or the restricted list is because all those compression enhancements and the ability to run those plants above capacity allowed them to market the gas. I think also coming into play was a lot of operators were pretty pessimistic about the OPEC meeting, and they were right. And so they looked at October and November as an opportunity to produce and sell oil at what may have been the high price for the next 6 months. So they were trying to move and sell oil as much as they could ahead of the OPEC meeting, kind of anticipating the $5 to $8 plunge that it took.
You said that was about 10% above capacity. Was that the number I heard?
Yes, sir.
How safe is that to be doing that for an extended period of time, or is that just a temporary thing?
Yeah, the question was the 10% above capacity for One Oak, and that's an accurate figure. And then the follow-up was, how safe is that to do that for an extended period of time? And clearly, it's not something you can do as you go into the really tough winter months, January, February, and March. And so they don't plan to continue that. They wanted to use all the compression that they had installed and spent money on, knowing that Lonesome Creek will be coming on towards the end of this month or in January, and they'll be able to go back to actually running probably 10% below nameplate capacity. That's where they'd like to be.
Do you want to give that volume again that they're running at? There's some confusion about what Lonesome Creek was running at for capacity. Give a percentage, but.
Okay, yeah, I gave a lot of numbers there, so I'm going to kind of walk back through them. And so the volume that One Oak actually ran above capacity was about 100 million cubic feet a day. Okay. So their nameplate capacity for their current plants is about 1 billion cubic feet a day, and they ran 10% above nameplate. Lonesome Creek will increase their nameplate to 1.2 billion a day, and they still think they'll be running about 1.1 billion.
Okay, I have a couple different questions that are relatively similar. I think people are still trying to wrap their head around the fact that completions went down, but production went up, and just kind of how do you wrap your head around all that, and how do you try to make sense of all that?
Well, the way I looked at it, I went back and looked at last month's director's cut and some of the numbers there that didn't make sense. For example, we had more than enough completions last month to have had constant production, or actually maybe a small increase in production, yet we saw a 25,000 barrel a day decline in production. This kind of looks like the good twin, and that was the evil twin, in that we don't have enough completions in October to maintain production, but we had over 260 wells that were idled in September as we kind of went into the whole gas capture problem and low oil prices problem. And I think companies brought a lot of those wells back online. That's why we're seeing the almost 7,000 barrel a day increase, but that's not sustainable without 110 completions a month. So, if we have continuous month after month of 40 and 50 and 70 completions, we won't sustain production. It will go back into decline.
Okay.
What else are producers going to probably have to try, I guess, to maintain production? You've seen a lot of mergers and acquisitions. Is that kind of a last line of defense, really, before things might kind of really slow down or shut down, or is there other things that they'd be able to do?
Sure. The question was, are there additional things that oil companies can do to try to sustain their drilling and completion budget with merger and acquisitions kind of looking like the last line of defense? And so if we kind of run down through the list, the very first thing they did was lean on rig companies and reduce rig counts in order to lower well costs and improve efficiencies there. And they got about a 25% reduction out of that. There's still a little bit of trimming that could take place there, but not a whole lot. Then they moved to the completion activity, and they've deferred completions and reduced completion costs, maybe another 10% that they achieved there. They've reduced operating costs by reducing personnel counts to the extent that they could. And so I don't know of any other tools that they have in their toolbox. It looks to me like selling legacy properties or selling some of their non-core Bakken and Three Forks assets is the last line of defense to keep the rigs operating and to keep the completion crews working. So obviously there's some optimism about oil price and clearly optimism about the long-term future, or these 9 new operators would not have been able to go out and raise the capital to buy these properties. So investors see it as a good play long-term, and these new operators see it as a good play long-term. But the folks that were in it and are trying to maintain drilling and completions, they're using that kind of as the last tool in their toolbox to keep cash coming in.
Okay, right along those lines, who are these companies getting acquired, and what are the new operators to North Dakota?
Well, I don't have that list in front of me or at the top of my head. We can certainly put that list together, and we'll have Allison do that. The company with the most M&A activity, the most sales or the most properties leaving the company is Whiting. And they're selling the bulk of their legacy assets and a little bit maybe of Bakken and Three Forks.
Okay, back to completions and ducks. Maybe it just disappeared. How can...
And I should mention, but go ahead while you find the question. 300 of those 700 wells is Occidental Petroleum. So those would be the 2 big ones. I don't want to just name a single company. So 300 out of the 710 wells is Occidental Petroleum exiting North Dakota completely. And that's Bakken and Three Forks. Okay,
back to completions and ducks. How can the number of completions fall drastically, but the duck count also fall? How does that work?
That's a great Where's Waldo question, and I don't think I have a final answer to that. Part of the situation is in our duck count or our non-completed well count, We include a lot of wells that are on confidential status that that look like they ought to be ducks. In other words, they look like they're going to be long-term non-completed wells, but the company actually picks up a couple of completion crews and trims away at that. So, and it may be a little bit of a timing situation. I would expect, looking at that statistic, that we'll see the November completion number rise pretty substantially. Hold me to that, and let's talk about it next month. But I would expect with the number of ducks going down that we'll see the November number rise. I'll give you a for instance, talk to one company who had 10 completion crews active at the end of 2014, and they have 0 right now. They're going to actually pick up a couple of completion crews, expecting that prices are going to improve, and they need to have their foot in the door so that as they need additional completion crews, they can add them. If they stay at 0, they're going to fall to the bottom of the list in terms of who the completion companies are going to be responsive to. So we're just seeing so much movement in that area, but I would expect the completion number in November to jump.
Anything?
With, so there's so many things in play right now. I guess what kind of impact is this having on your guys' office in terms of things? Are you having any kind of shift, in what you guys are doing in terms of inspections or future staffing levels, things like that? Are you guys seeing any kind of shift with some of the operations and some of the field things that you guys are doing?
Yeah, so the question was, how do all these changes affect us staff-wise, and what are we adjusting to? Clearly, we have changed our field inspection emphasis from drilling rigs to oil conditioning, flaring, field inspections of saltwater disposal wells and producing facilities. In the office, the merger and acquisition has become a huge area. And so every one of these wells has to go through a review before it can be transferred to a new bond. And they're not able to transfer wells that have non-compliance issues. So we're spending a lot of staff time on reviewing these 710 wells to identify the ones that have compliance issues and can't be transferred, and getting bonds in place for these 9 new operators and making sure that we only transfer wells that don't have a complaint or some kind of a problem. And then the last part is we're just implementing a policy. As you know, the commission decided last month to be pretty generous in terms of extending the non-completed status. And so we're busy putting some guidance and a policy in place to help operators know what they've got to do to get that extension, and to help our field people know how they're going to inspect and enforce those NC wells, so that we don't end up with a well out there that causes some kind of a spill or some kind of problem.
Okay, question from the webinar. How does today's estimated price compare with historical prices?
Great question. We haven't been here since December of 2008. So this is a 7-year low. And I got asked the question this morning, is this belt tightening or gloom and doom? And I think it's still belt tightening, and we're going to see another 6 months of that. To me, gloom and doom would be if we fall to those December 2008, January 2009 rig counts, which were in the 30s. That's real gloom and doom. But at 65, even with the potential for another 10 being idled over the next 6 months, that's belt tightening.
Can you discuss if there's any similar trends running over nameplate at the Tioga Hess plant as at One Oak? If not, what's the difference?
Yeah, so the question was comparing the big Tioga plant with the 1 BCF a day capacity at One Oak. The Tioga plant's actually only running at 85% of capacity. A lot of that is because the Hawkeye project never got done. Still very optimistic. We just recently met with Hess. They're still very optimistic that they're going to get that line installed and that compression installed by the middle of next year. They've also looked at some debottlenecking and looked at, their nameplate capacity of 250 million a day. And they have been doing some interconnects to take in some other operators' gas. They think that they have the potential to debottleneck that plant and take it to 275, maybe even 300, before they would have to do a major overhaul or expansion of the plant. So they're running 15% below nameplate, hoping that by this time next year, they'll actually be running 10% above nameplate.
Okay, back to oil price. Again, maybe more of a where's Waldo question, but prices stay below $50. Do you have a guesstimate as to when monthly production could fall below 1 million barrels a day?
We're putting those numbers together currently to share with Moody's as they try to work on a new forecast for the state. Actually, at current prices, we've got production falling to just at or maybe slightly above 1 million a day. So we don't expect to go below that million a day number at these prices.
Do you have a time period guesstimate as when that happens?
The end of the biennium in the June-July 2017 timeframe.
Okay. Let's see. Okay. Based on your thoughts of belt tightening, not gloom and doom, are producers expecting prices could rebound by mid-2016? Why the optimism?
Visiting with the operators, they do expect significantly better prices in the second half of 2016. And they're trying to position themselves through the permitting and the case process and through, like I talked about, actually adding some completion crews that are going to strain the budget a little bit to be ready to expand significantly in the last half of 2016.
Any more thoughts on how OPEC could impact North Dakota production? And are North Dakota producers competing for market share?
Well, I'll take the last question first. Competing for market share would be no, because they can't export their oil. And so North Dakota producers are bottled up within the borders of the U.S. in terms of what they can do, even with their natural gas liquids to some extent. OPEC obviously still has a significant percentage of the world's production, I think right around a third of world production and consumption. And producing at record levels is tremendous downward pressure on the price, and that affects North Dakota operators significantly. OPEC's projections on world oil consumption say that cuts in their production won't matter until the second half of next year. And at that point, they think the world markets are going to be roughly in balance, and they could make some small production cuts and see significant price increases.
Could you kind of better define or clarify what you mean by mergers and acquisitions? Do you really mean operators merging together, or do you mean that a number of wells are being sold to operators in and outside of North Dakota?
The bulk of the 700 wells I've talked about are actually acquisitions. It's 9 new companies buying North Dakota properties from existing producers. I call it merger and acquisition. I'm not aware of any current significant merger activity of an existing North Dakota operator merging or combining with another one. These are asset sales.
Okay. And a couple of you have, actually many of you have requested that list. So I will get that together as quickly as possible, and I will just send it out to everyone that has attended the webinar today. That's probably just making sure my bases are covered, but I will make sure I get that to you as quickly as I possibly can. I'm not seeing any other webinar questions, so this will be your last call if there's nobody else in the conference room with any questions. Going once, third type fast, going twice. Hold to Justin Kringstad. Coming up next. Yeah.
That's me a snack.
Yeah.
Those things are terrible,
Lunch.
so.
I like the mint ones.
I think that's what he gave me one time, was like a peppermint one. And
Those are good.
I like threw it back at him and was like, I'd rather be hungry.
Well, perfect. Hello, everyone. Justin Kringstad, Director of the North Dakota Pipeline Authority. We'll get started right in with some of the production updates you heard from the North Dakota side. Montana, another month added to this table. We're continuing to see that slide. Montana currently has no drilling rigs active, so we'll likely continue to see some decreasing production on that side of the play. Again, then impacting the takeaway and the transportation dynamics in the Williston Basin as a whole. Very little change, again, month to month on how the oil has been leaving. We did not have any major market shifts, we did not have any major projects come online, so no big movements as far as market share changes between September and October, between pipe, rail, and refining within the basin. Again, just that historical chart, again, with the spread between Brent and WTI staying historically low. Again, some more barrels being attracted to the pipeline side versus rail in the month of October. Again, not only market driven, but in September we did have hydro tests taking place on the Enbridge system, which did impact shipments out of North Dakota on that pipeline. That was back in service in October, so we saw, again, some of that pipeline uptick between September and October. Because of that, very little change in production out of the region. We did see, with additional barrels going by pipe, the amount estimated to be leaving by rail car did slightly move downward in October versus September. And then the destinations, again, this is from September, the most recent available at the federal level. Most of that oil continues to be heading towards the East Coast, that PADD 1 region, again, then followed up by the West Coast for PADD 5. Slide 7, just a update on pricing. This was again September from the federal EIA, what refineries were paying in the different parts of the U.S., again correlating then with some of those destination market share we saw on the previous slide. But again, East Coast, West Coast, and then followed by the Gulf Coast having the highest price refinery acquisition cost in the U.S. And where we sit today, just under $3 spread between Brent and WTI. Again, no big changes this fall and coming into the early winter. So I don't expect any major shifts between that pipe and rail market share. Again, it's going to be likely driven by production changes, as well as if there is some type of big pricing movement in the U.S. And then truck imports, exports. We did see the number of exports go down in the month of October. That may have been driven by, again, some of the work that was being done in the pipeline systems. But imports into North Dakota stayed at those higher levels that we had seen spiking up here in the last couple of months. So we're going to continue to watch that and see if that's something, again, that is going to be a continued trend of those barrels coming in North Dakota from Canada, or if this is going to be a temporary phenomenon. On the flaring side, you heard from Lynn as far as the decrease in the percentage of gas being flared. Where that was taking place was primarily on wells that were connected, having additional either processing or compression to get that gas from those wells to one of those plants and then processed and get that onto the interstate pipeline system. So we continue to see that 3% from the zero sales wells. Those are wells that were not connected to a pipeline. The biggest movement was in those wells that did have a pipeline connection, but in the past just didn't have the capacity to move all the gas from those wells. And so We'll likely continue to see that move in a positive direction as some additional gas plants come online here in the next several months. And then last but not least, the number of gas connections, getting those wells connected to these gas plants, we continue to see that outpace drilling activity in the month of October. So again, positive sign when they're getting more wells connected to these gas gathering systems that are being drilled. So with that, I'd be glad to answer any questions.
The Dakota Access Pipeline, of course, South Dakota approved it. But it was a 2-to-1 vote, and there was some concern that the company was using some strong arm tactics on that. Have you been hearing anything like that through North Dakota?
And so the question was the Dakota Access Pipeline and the regulatory process and getting approval in South Dakota and some of the issues that the Public Utility Commission of South Dakota had raised. Again, on a pipeline of this size, some of those issues we're likely going to hear them in North Dakota as well, as far as making sure that company, how they're handling those contacts with landowners. In my opinion, that needs to be done properly and needs to be done respectfully and to come to an agreement. So I hope that the company and the Public Service Commission in North Dakota continues to work through any issues that they're seeing in their process.
Follow up, didn't they have a work session on Dakota Access on Monday? Were you aware of that?
I was not at that meeting, no.
Any magic number that the WTI Brent spread needs to be to see a substantial shift from pipe to rail or vice versa?
Let's move to slide 4 here. So when we look at that question of, what price do we see some triggered movement, it appears to be, just looking historically at the data, somewhere between that $5 to $7, $3 to $7 range where we start to see some movement of barrels shifting from pipe to rail. So in this sub-3 environment today, I would expect that most of those barrels are going to try and find pipeline space if they do have that flexibility in their marketing department.
Any thoughts on the trend of the 3 months of high truck imports from Canada? Any thoughts on that trend? The reporter asked the pipeline outage was midsummer, so it doesn't seem to make sense. Any thoughts?
Well, so the September, the October, the high imports, again, as far as what's taking place with those barrels, if they're coming down here, we don't have any additional information as far as the destination of those barrels. If they're coming into North Dakota to get onto one of the rail facilities, if they're coming in to get on pipeline space, if they're coming in for any type of marketing, if they're going to do any blending, that type of work with lower quality grade crudes in North Dakota, we don't know that side of it. But we do know that in September, Enbridge did have their hydro test, which did impact their ability to move barrels out of North Dakota on their pipeline system. But then again, in October, they were back in full service, and so we did see some of the exports decrease, likely as those barrels had the option to move either by pipe or rail within North Dakota without having to make that additional trip north.
Are any of those, that tar sand oil too, involved in that, coming from Canada?
No, so the question was the crude grade from those barrels. No, those are going to be Williston Basin barrels, just north of the border, and so those.
Saskatchewan.
Correct, yeah.
Go ahead, Nick.
With things slowing down as they have this year, heading into next year, do you think the number of miles on infrastructure build out spiked in recent years? Do you expect that to maintain, or do you expect to see kind of a decline through 2016 in number of miles? Yeah,
so the question was the amount of infrastructure being built, number of miles. Likely, when we look back at what's going to take place in 2015 and even going into 2016 here, we'll likely see a decrease in the number of miles, but an increased focus then, because all the activity is concentrated in a smaller geographic area, hence you're going to have less miles that you need to cover with some of these systems, but at the same time more focused then on compression, getting gas processing expanded in the right places. So again, we've got less of a footprint to deal with during this time period, but just a higher concentration of say, natural gas production in some of the higher crude production areas.
As a follow-up, is that kind of a good thing? Is that maybe a positive of the slowdown, at least in some of those areas?
Well, so it's, when you look at it, depending upon, the question was, is that a positive for the, say, the gas processing industry? It's got its pros and its cons. Again, you've got less geographic area that you have to manage when the rigs aren't spread out as much, but then at the same time, you've got everything concentrated, and schedules that you may have thought were going to be the case a year ago, 6 months ago, those have been shifting very rapidly. So there's a whole other host of challenges that have sprung up as part of it as well.
Okay. I don't see any more questions. So we'll leave it at that.
Okay. Thank you.
Thanks, everybody. And again, for the folks that are looking for that merger and acquisition information, I will get that to you just as quickly as I possibly can. So thanks, everyone, and we'll see you next year, right? Merry Christmas,
That's right.
everyone.
Merry Christmas.